On March 5th, 2026, Bloomberg reported that Oracle was planning to cut thousands of jobs across multiple divisions. Within 2 days, a familiar narrative took hold across global tech media. Oracle cut staff to fund AI. Estimates suggested as many as 3,000 positions could disappear, up to 18% of the company's workforce, freeing billions for data center investment. The implication was clear. Artificial intelligence is eliminating jobs. But a closer reading of the underlying financial reality tells a different story. Oracle is not replacing tens of thousands of employees with software agents. It is managing a balance sheet under strain. The company has accumulated more than $100 billion in debt after an aggressive borrowing spree to finance infrastructure projects for major AI customers. It has already disclosed a $1.6 billion restructuring charge, largely severance costs, and is reportedly considering asset sales. This is not primarily an automation story. It is a capital allocation story, presented in the language of technological transformation. The pattern beneath the headlines Oracle's situation is not exceptional. It reflects a broader restructuring template now visible across large technology firms. Headline layoff figures rarely correspond to the number of employees actually dismissed. Announcements often combine multiple adjustments: canceled hiring requisitions, denied backfills, internal redeployments, and shifts to contract labor. When Meta announced its wave layoffs in 2023, the plan included eliminating 10,000 roles and closing 5,000 open positions. The headline layoff count combined actual exits with jobs that simply never got posted. Oracle's own FY 2025 10K discloses that 29% of open, non-entry-level positions were filled internally, roles disappearing on one side of the org chart while people reappear on the other. The same filing references multiple restructuring plans with staggered accruals and cash payments across quarters. Not a single day of layoffs. A rolling portfolio change in labor demand. The effect is organizational churn rather than simple contraction. People exit one function and reappear in another. Roles disappear on paper while work continues through different employment channels. What the SEC filings actually show, annual filings, illustrate the scale of this dynamic. I pulled the 10K employee disclosures for the 5 companies that have dominated layoff headlines over the past 2 years. Company headcount, before headcount after, net change during this period. Amazon 55,000, end 2023, 156,000, end 2025, Live 1,000, Salzano 3,000. Corporate layoffs announced: Alphabet, A2 502, end 2023, 18323, end 2024. Said it won 4 years of serial layoff headlines. Microsoft 221,000, June 2023, 228,000, June 2024, 7,001, 900 gaming. Plus, Azure cuts pause multiple ways. Meta 74,067, end 2024, 78865, end 2025. E4 79885%. Low performance cuts in Jan 2025. Oracle 159,000 events. FY 2024 16,200. FY 2025 3,000. Now reportedly planning to cut up to 30,000. Every single one of these companies grew headcount during the period in which layoffs dominated the news cycle. Amazon's case is particularly instructive. In 2020 and 2021, the company hired 81,000 people in 2 years, more than doubling in size. What we are watching now is not AI-driven contraction. It is the cleanup of the most chaotic hiring binge in corporate history. The dominant trend is not workforce collapse. It is workforce substitution. Large numbers of departures coexist with continued hiring, often in different geographies, seniority levels, or business units. Why markets reward layoffs? The persistence of layoff headlines reflects a powerful financial incentive structure, one that is worth understanding in detail because it explains why the pattern repeats. Payroll is typically the largest operating expense in technology companies. When restructuring is announced, cost reductions flow quickly into operating margins and earnings per share, often within 90 days. Salaries, benefits, equity compensation, office costs, all removed from OPEX within the quarter, the cuts take effect. The restructuring itself is reported as a one-time charge. Analysts and investors routinely strip these charges out of their valuation models. They look at adjusted earnings, not GAAP earnings. The arithmetic of a layoff Oracle's case illustrates the mechanics precisely. Amount restructuring charge, one time, largely severance. $1 $6 billion cash flow freed by workforce reduction, $10 billion return on restructuring costs, 566x total debt on balance sheet, $108 billion debt accumulated in 2 months, data centers, $58 billion. The severance cost is treated as noise. The ongoing margin improvement is treated as signal. The company takes a short-term accounting hit that Wall Street ignores in exchange for a permanent cost reduction that Wall Street rewards. The double play: if the layoffs are framed as AI-driven efficiency, the narrative becomes doubly rewarding. Not only is the company more disciplined on costs, it is also perceived as forward-looking on technology. The stock receives a discipline bump and an innovation premium simultaneously. The timing reinforces the incentive. Reuters reported Amazon's 3,000 job cut plan ahead of an upcoming earnings report. Oracle's thousands of planned cuts surfaced in the same reporting cycle as its quarterly results. Meta's January 2025 cuts landed just before earnings season. None of this requires conspiracy. It does not even require bad intentions. The incentive structure, one-time charge ignored by analysts, permanent margin improvement rewarded by markets, AI framing as a bonus, makes layoff announcements a rational shareholder value play, independent of whether AI has actually automated a single role. The gap between narrative and evidence corporate messaging increasingly attributes workforce reductions to artificial intelligence. Yet empirical research paints a more nuanced picture. A 2025 survey by the Federal Reserve Bank of New York found that among service firms adopting AI tools, metric share of AI-using firms laid off workers because of AI past 6 months, % hired fewer workers because of AI past 6 months, 12% hiring reduction concentrated in high college degree roles, 1% firing, 12% not hiring. The distinction is everything. A February 2025 NBER working paper by Hampole et al. Provides the framework for understanding why the gap exists. AI does substitute for specific tasks. A 1 standard deviation increase in task-level AI exposure is associated with about 2% lower demand for skills linked to that task. But productivity and growth effects can offset these losses elsewhere. The net employment outcome is modest, which makes it easy for cost-cutting reorganizations to be rhetorically AI-washed. The numbers behind the noise: nearly 5,000 tech jobs were cut globally in 2025. AI was cited as the cause in approximately 55,000 U.S. job cuts, according to Challenger, Gray, and Christmas. But the actual causal chain: did AI replace these specific roles, or did the company use AI transformation as convenient framing for cost-cutting, post-pandemic correction, or shareholder appeasement, is almost never examined. Forrester's Predictions 2026 report went further. It predicted that half of AI-attributed layoffs would be quietly rehired, but offshore or at significantly lower salaries. According to Forrester, 55% of employers already reported regretting laying off workers for AI capabilities that did not yet exist. Klarna is the textbook case. The company replaced 700 customer service agents with an AI chatbot, announced it publicly as a success, then rehired human agents after quality collapsed. The CEO admitted they had let costs dominate the evaluation too heavily. The publicity cycle rewards announcements. The operational reality often unfolds quietly months later. The real labor market shift. Hiring retrenchment. The most consequential workforce change in the technology sector is receiving comparatively little attention. It is not mass layoffs. It is a sustained contraction in hiring pipelines. Nobody writes Amazon does not hire 3,000 people it would have hired. The macro picture indicator from to change computer systems design employment, BLS 2478600, Jan 2023 2382100, Feb 2026 96500 information sector employment, BLS 3061000, Jan 2023 2882000, Feb 2026 249,000 information sector job openings, JOLTS 47,000, DEC 2021 8,000, DEC 2025 164% total U.S. job postings versus pre-pandemic, Indeed. Baseline plus 6%, DEC 2025, near flat AI mentioning postings versus pre-pandemic, Indeed. Baseline was on 34%, DEC 2025. Surging Indeed's data reveals the critical nuance. AI mentioning postings are rising as a share precisely because overall postings are declining. The hiring market is not expanding, it is concentrating. Federal Reserve Chair Jerome Powell characterized the current labor market as a low hire, low fire equilibrium. Companies are not aggressively cutting, they are simply not replacing. The entry-level collapse. The data on early career roles is where this becomes visible. Source finding, Revelio Labs entry level. U.S. job postings down 35% since Jan 2023, RISI. AI, UK, Data UK tech graduate roles down 46% in 2024. Projected further 53% drop by 2026. The rest of world Indian IT entry-level roles cut 20-25%, EY estimate. Signal Fire 50% decline in new grad roles starts at major tech firms, 2019-2024. Handshake software company posting volume at 40% of 2021 levels. Revelio Labs, task composition, AI exposed tasks and job postings fell from 29% to 25%. 5%. 2022, 2025. That last finding is particularly revealing. Companies are not just posting fewer roles, they are stripping automatable duties from the roles they do post. The job itself is being redesigned around AI before a human ever applies. The academic evidence. The most rigorous evidence comes from the Stanford Digital Economy Lab. Eric Brynjolfsson and co-authors used high-frequency payroll data from ADP and found that early career workers ages 22-25 in AI-exposed occupations experienced 16% relative employment declines, while employment for experienced workers remained stable. The adjustments occur primarily via employment rather than compensation, meaning companies are not paying juniors less. They are simply not hiring them. BLS data shows programmer employment in the U.S. fell 5% between 2023 and 2025. Software developer employment, a more design-oriented category, fell only 3% in the same period. The roles most susceptible to AI automation are the ones disappearing fastest. Artificial intelligence is concentrating demand into a narrow set of specialized roles while reducing the volume of entry-level hiring across the broader economy. A generational bottleneck. This dynamic is producing a structural tension. LinkedIn's January 2026 labor market report captured the collision in a single chart. Record numbers of computer science graduates entering the market at the exact moment entry-level software engineering hiring hit record lows. The pipeline is producing more candidates than ever for positions that are evaporating. Forrester found that Gen Z workers have the highest AI readiness score, AIQ, at 22%, compared to just 6% for baby boomers. The generation most capable of working productively with AI is the generation being locked out of the workforce by the elimination of entry-level positions. The NAC Job Outlook 2026 survey found that approximately 45% of employers now characterize the job market for new graduates as merely fair, the most pessimistic rating since 2020. Employers project a marginal 6% increase in hiring for the class of 2026 compared to 2025. Adjusted for the increasing number of graduates, this is a functional contraction. The traditional career ladder, routine tasks followed by mentorship and advancement, is under strain. The tasks that juniors use to learn on code generation, financial modeling, baseline research, pitch book preparation are the exact tasks AI handles best. This is not a temporary cycle. This is a structural redesign of the entry point into the professional workforce. Three forces often confused. The noise becomes signal only when you separate three phenomena that the media constantly conflates: what it is not. Post-pandemic correction, Amazon, Alphabet, Meta, Microsoft hired hundreds of thousands in 2020-21. They are still cleaning up. Net headcount has barely moved. AI-driven contraction capital reallocation, 5 firms plan $700 billion in AI-related capex in 2026. Oracle is cutting people to build data centers, not because AI replaced them. An automation story. The silent replacement entry-level postings collapsing. Hiring velocity at decade lows. The labor market contracting through omission. Roles that never get posted. Headline News One counterpoint worth noting. Eurostat's EU-level data shows ICT specialist employment surpassed 10 million in 2024, reaching 0% of total employment, and the share is still rising. The U.S. tech-adjacent sectors have been contracting since 2022. The EU's specialist workforce has not. This does not mean Europe is immune. The entry-level squeeze is visible there too. But it means the picture is not uniformly bleak. It means there is still a window. The first two forces dominate the headlines. The third is the one that will reshape the economy. What this means if you run a business. If you are reading headlines about AI layoffs and concluding that AI is making companies more productive with fewer people, you are reading the wrong story. The companies announcing the largest layoffs are not the companies that have figured out AI. They are companies managing debt, correcting for overhiring, or reallocating capital toward infrastructure bets that may or may not pay off. Oracle's 3,000 cuts have nothing to do with AI agents automating anyone's job. They have everything to do with a 108 BN debt load and a cash crunch. The companies that have actually figured out AI, the ones I wrote about last issue, look nothing like Oracle. They are 1 to 50 person teams built around AI from day one. They do not announce layoffs because they never hired the people in the first place. Meanwhile, the real risk for most businesses is not that AI will eliminate your workforce. It is that AI will eliminate the pipeline of people who would have eventually become your workforce. If entry-level hiring contracts by 35-50% for 5 consecutive years, who becomes your mid-level manager in 2031? Who becomes your director in 2035? The question no one is asking is not, how many people will AI replace? It is, who will we have left to promote? Fabio Lauria, CEO and founder, Electi. This article is the second in a series on how AI is restructuring the operational architecture of businesses. For a deeper operational analysis, see the white paper, AI for European SMEs, the 2026 playbook. Sources, Bloomberg, Oracle layoffs to impact thousands in AI cash crunch. March 5th, 2026, Fortune, Oracle under pressure for more than $100 billion in debt and massive layoffs. March 9th, 2026 is Wolf Richter, Wolf Street. Despite 4 years of mass layoffs at Alphabet and Amazon, headcount rose in 2025, nearly flat with peak as hiring continued. February 9th, 2026 CNBC. Amazon layoffs 16,000 jobs to be cut in latest anti-bureaucracy push. January 28th, 2026 Amazon, Alphabet, Microsoft, Meta, Oracle. 10K annual report employee disclosures 2023-2025. Federal Reserve Bank of New York. Liberty Street Economics, August 2025 Regional Business Survey, AI Adoption and Labor Effects. Hampel et al. Artificial Intelligence and the Labor Market, NBER Working Paper, February 2025. Revised September 2025, Brynjolfsson et al. Stanford Digital Economy Lab, ADP Payroll Data Analysis. Early Career Employment Effects. Challenger, Gray and Christmas 2025. U.S. layoff data, 55,000 AI-attributed job cuts. Forrester Research, Predictions 2026, The Future of Work, Rehiring Prediction, AIQ Data, Indeed Hiring Lab, January 2026. U.S. Labor Market Update, January 22, 2026, LinkedIn, January 2026. Labor Market Report, CS Graduate Hiring Data. Revelio Labs, entry-level job posting decline data, AI exposed task composition analysis signal fire, entry-level hiring decline study 2019-2024, Handshake, early career platform posting data BLS Fred, payroll employment series, computer systems design, CES 605415001, and information sector, JOLTS job openings Eurostat, ICT specialist in employment 2024, CNBC, AI is not just ending entry-level jobs, it's the end of the career ladder as we know it. September 2025 IEE Spectrum, how AI is reshaping entry-level tech jobs. December 2025 ANS Job Outlook 2026 Survey Information Week, 2026 Tech Company Layoffs Tracker, March 2026 Fabio Lauria, CEO and Founder, Elect SRLPS. Se ti interessa approfondire come l'AI sta trasformando non solo lo spazio ma anche il business sulla Terra, continua a seguire questa newsletter. Welcome to the Electe newsletter. This newsletter explores the fascinating world of artificial intelligence, explaining how it is transforming the way we live and work. We share engaging stories and surprising discoveries about AI, from the most creative applications to new emerging tools, right up to the impact these changes have on our daily lives. You don't need to be a tech expert. Through clear language and concrete examples, we transform complex concepts into compelling stories. Whether you're interested in the latest AI discoveries, the most surprising innovations, or simply want to stay up to date on technology trends, this newsletter will guide you through the wonders of artificial intelligence. It's like having a curious and passionate guide who takes you on a weekly journey to discover the most interesting and unexpected developments in the world of AI, told in an engaging and accessible way. Sign up now to access the complete newsletter archive. Join a community of curious minds and explorers of the future. Subscribe now